officially call the meeting to order at 8:03. Take a quick review of the minutes. Does anybody have any comments or corrections of the May 3rd, 2021 minutes? Hearing none, how about the minutes of December 6th, 2021? No. Can people hear me?
Yeah.
Just checking.
Yep.
All right.
Good.
A couple housekeeping items here. I didn't get an updated agenda. I know, Melissa, we had added something with regard to the experience study. I think we'll do that kind of as housekeeping items before we open it up to Chris and Tyler. But we need to appoint a chair for this year and also a vice chair. I guess I would throw my hat in the ring for chair if unless anybody else has a really strong interest in it. I'll open it up for discussion.
I make that motion that we make Derek Peterson the chair.
I'll second. Oh, I'm not on the committee. I can't second it. Never mind.
Thank you. Is that Sean? Thank you, Sean.
Yep.
I'll second.
Then, thank you. And do we have to? Are we taking a vote on this, or is it just an appointment?
Yeah. Just
Well, all those in favor?
Aye.
Aye.
Okay. Would anybody have an interest in joining as vice chair, or is that somebody you want me to pick?
I think you can go ahead and pick Derek. I have no issues.
Okay. Well, I know
Chris or Rob.
I'm sorry. Go ahead, Sean.
I was just giving you a hard time. Go ahead.
Oh, yeah, exactly. How about Lisa? Are you interested? Are you able to?
I'm not technically on the committee, but thank you.
Oh, you're not? Okay. So who on the committee? How about Sean? Are you interested?
I would serve at your pleasure, Mr. Chairman.
Oh, man. All right. Wonderful. Thank you.
Thank you.
We can cross that off. And then, we're going to have, I spoke to Lisa last week, in terms of our pension plans, there's something that the kind of the Government Finance Officers Association, as fiduciaries of pension plans, they recommend that we do various studies to make sure we're on track and keeping up, kind of our estimates for contributions to the plan, make sure we're staying on track. And there are a couple things we can do. One of them is an experience study, which is really a back test of our actuarial calculations over a 3 to 5 year period. And it just gives us better forecasting tools. It is, kind of best practices, and it is recommended that we do an experience study once every 5 years or so. It's been 10 since we last have done it. So I think, I want to open it up to the group to discuss whether we think that's something that, we should be doing. I think it's generally low cost, and somebody can correct me if I'm wrong, but I think it's somewhere to the tune of $12,000 or $13,000 per plan. And I think it's something, we should consider. The other thing is there's also what's called gain loss analysis. There's also what's called a gain loss analysis, which is more point in time, but it is something we might want to do. I don't know what the cost of that is, additional cost of that is. But again, we're talking about minimal cost here. And then part B of the discussion should be where, we think the money should come to pay for it. Now, presumably, there is some level of cash balance within the investments at the pension plan. And, my recommendation would be that provided there's enough cash in each of these plans, that the plans themselves pay for it. If the plans had to liquidate an investment in order to do it, I would recommend that we that as a subcommittee of the board of, what I would recommend is that came out of the general fund as opposed to the individual plans if we had to liquidate investments in order to do that, because there'd be fees involved likely. I'll open it up for discussion in terms of thoughts on the actual experience study and at the addition of potential gain loss, and then where it should come from, who should pay it. Anyone? Yes, Chris.
I would just confirm, Mr. Chairman, there is ample cash in the plans. They typically run with a little bit of liquidity, so you should be able to accommodate from within the plans without any liquidation.
Great, thank you, Chris.
Derek, I support the recommendation of both doing the study and as we just talked about, cash from the plan to fund them.
Great.
Derek, it's Chris Peterson. Or whomever can educate me. Full support. I agree. Certainly with doing the evaluation. And do they come with do they come tailored, if you will, with a focus on the dynamics and of our plan and our plan participants, geography, concentration, male, female, age, focus on public works, police, safety. So do they hone in that deep to us, or is it just a general study based upon a certain amount of participants at a certain average age with fun? Just curious.
I believe it's custom tailored to the demographic, as the demographics you described. Lisa, do you have any additional on that? I don't know too much about it, but
sure. It was so in 2012. I don't know. I haven't seen the recent things, but is Amy on the line? Because she could speak to that as well.
She's not yet. She got caught in traffic, so she's a few minutes behind.
That's all I needed. Thank you.
Okay.
Education.
No, that I totally understand. Same with me. Because it has been 10 years, but I would imagine that we would get some level of scope of the report prior to paying for it, and that's something we can review as a board as well. So yeah, I appreciate the question.
GFOA, which is what Derek referenced, does say what it does is it looks at the plans assumed and their actual experience. So it does go into the details of what actually happened, were our assumptions reasonable and right, and it helps us get closer to accuracy, which is something that is helpful.
So just point of order, if we are all in agreement that that we should do an experiential study, why don't we just kind of look at that in itself? I don't know if we need to add. I don't know the additional level of detail a gain loss study would show us. Maybe we want to. Maybe we'd like to see just what that entails as well. But what do we want to? Is it something that we should vote on? If we're going to direct these funds, from the individual pension plans for this study. And then I guess the next question would be, how do we move that to next steps?
Derek, can I make a suggestion?
Of course.
So I think it would be helpful just to take a motion on this to recommend it to the Board of Finance. The Board of Finance will then have to vote on it. I suspect that this is not a controversial vote since it's pretty much housekeeping as you describe it. But since technically, I think our duty is to consult with the other two boards, which we have done today. But if everyone's in agreement, why not?
Okay. Would someone please make a motion that we recommend to the Board of Finance that we do an experiential study?
I will make that motion.
I'll second that.
Thank you.
And
Any
then further move
discussion?
that we recommend that it be paid for out of funds from the plans.
I would second that further as well.
So the full motion amended as Robert added. Any discussion? Hearing none. All in favor?
Aye.
Aye.
Aye. Okay. Thank you for that. And we can move on to number 4 of the meeting agenda, the pension plan and OPEB fourth quarter performance reviews.
Well, great. I'll get started here. Good morning, folks. Good to see everyone. Trust everyone's well. If you could, Melissa, we'll dive right in here and work through my collateral, and then obviously Tyler will share his inputs. We continue to grow. Just as a quick firm update, continue to grow, but do so thoughtfully. So we will go through these 2 pages of update here. We'll leave that to the board's interest, but there's lots of collateral out on the website. If you're so inclined to look at it, just join the website and you'll see that, and then you'll see the hirings that we continue to do last year and into 2022 as we thoughtfully grow, but do so in a manner, as we always remind you, that doesn't impede in any way the level of service that our existing clients receive. And the integration between ourselves now and DeMayo Schneider is complete and full, and we're kind of operating a full scale, and everything's in good working order. So with that, if we could, Lisa, just jump ahead quickly to page, I think it's slide 10. We'll spend a few minutes on capital markets and what's going on fourth quarter and then into this year as well. And really, I think as folks can well surmise, the environment has changed a good deal over the last couple of months. And I think as we've previewed in our previous meetings coming into the end of the calendar year, among the things that have pressed on investor sentiment, of course, have been the evolving nature of the Fed's stimulus programs and them becoming more austere, both in terms of expectations for higher interest rates and withdrawal of their asset purchase programs, and varying levels of that type of activity with counterpart central banks around the world as well. We obviously have the ongoing challenges from the variants and the like, geopolitical risks, and what we've seen, although the fourth quarter was a reasonable one that we'll see for returns, you've obviously seen in January a good deal more of stress in the markets. Just as we kind of take pause and as the new year starts, investors kind of continue to, evaluate all of these different concerns. The undercurrent is one that still remains macroeconomically pretty solid, right? So we've got this interesting dynamic of those headline challenges pressing on markets a little bit, yet really pretty consensus and consistent expectations for global growth to continue to proceed into this year, into 2023, albeit at somewhat moderating paces. Anyways, the takeaway really, I think, as you see there, adaptability, flexibility, we think are, key tenets as the new year takes hold, right? Not unusual to have these periods of heightened volatility and a little bit of digestion on the returns front, even if the undercurrent remains a constructive one. So the programs, as you know, are well diversified and really designed with that type of environment in mind to kind of weather these types of scenarios. More explicitly on the capital market front, you'll see there is noted in the upper left-hand corner of the page, we continue to have these varying levels of sponsorship in terms of what's working best in markets. And we started the pandemic with the big large cap names in the US doing particularly well and the growth names doing well, the stay-at-home stocks, you'll remember. And then we had rotation through the elections into small cap names and value styles and some of the international markets doing well. At the end of the calendar year, we reverted back a little bit to where we started. Interestingly enough, into the new year, we've actually had in January a bit back to international stocks doing a little bit better, and value stocks and smaller stocks not as much. But so we've no surprises, right? That interests in particular categories of the markets kind of fluctuate as data comes in and investors recalibrate, if you will. So that's a kind of a quick take on markets. If you could, Melissa, jump ahead 2 pages is quickly to frame for the committee what went on. So you'll see here on the page asset class returns across the spectrum. Fixed income or the graphics on the first half of the exhibit there. Then you see equities with the gray bars and some of the other asset classes off to the far right. Really the takeaway both for the quarter and year to date, certainly in the fixed income markets, as you can see, is it was a pretty challenging year for fixed income investing. That third category in core bonds is the broad representation of U.S. investment grade bonds. And you see there kind of a flat fourth quarter and actually down about a 1.5 for the full year, really against, right, or confronted by what was a press higher in interest rates. And obviously that is a headwind to fixed income returns. The equity markets in the middle of the page, by and large, had a decent quarter, as you see there. Again, as mentioned, led by large cap, up almost 10% in the quarter, but small and international developed markets positive as well. And all 3 of those constituents, as you see, having solid double-digit returns for the full year. Emerging markets, the situation in China, and some of the actions that authorities have taken there on the regulatory front has obviously been of concern and pressed on EM returns. And it's been a degree of contagion effect into the broader emerging markets. And so they were down, as you see there, for the full year. Again, interestingly enough, emerging market equities in January and year to date are the best relative performers of global equities. So this back and forth that we talked about. And then you see to the far right, things like REITs and real assets and commodities. You've read about inflation pressing a bit higher. And clearly that backdrop has been constructive for things like real assets and certain commodity markets. And when rates were well behaved, REITs as a source of incremental yield had a dynamic year, as you see there. They've actually struggled a little bit calendar year to date in 2022. So kind of a mixed bag on the capital market return front. Let me pause there for 30 seconds before we transition into some of our plan-specific collateral. Any questions from the committee just on markets broadly?
Chris, I'm just curious your thoughts on, the 30 trillion in national debt, our interest cost, the largest budget line item. How, with JP Morgan and Bank of America talking about between, call it 4 and 7 rate hikes this year, where do you see kind of, the 10-year, or the, treasuries going, if that is the case? And are we seeing any of that baked in today, with, almost nearly, 2% on the 10-year treasury? Just curious your thoughts there.
Yeah, so it's a great question, Eric. You have seen effect in the markets, right? If you look at the yield curve, right, the representation of yields across the entirety of the treasury markets, for example, it has flattened a good deal as we've gone through the year. That's no surprise, right? Because as you describe, the front end of the curve is what the Fed can control to an extent. And as you mentioned, right, the markets are anticipating rate hikes, and that's starting to get baked into the front end of the curve, and those rates start to go up. On the back end of the curve, kind of interestingly enough, as you kind of hinted as well, right, I think there's concern from investors about deficit financing, what that may mean for economic growth more broadly. And you've seen those longer dated returns stickier, right? So you've had this flat effect in terms of the yield curve. And we suspect a good deal of that flattening now has taken place, right? Because the markets run, as you all know, in an anticipatory fashion. So they've kind of caught up to those expectations, if you will. 10-year, I think when I last looked on Friday, what are we in 1.7s, I think, or thereabouts is where we finished the week. And we would expect it to kind of bounce around that level in the middle of the yield curve over the course of the next several months. So maybe something like between 165 and 185 or something like that, but probably not to move all that dramatically, because the bigger effects are out on the two tails of the curve. Typically, we kind of rotate into a new economic environment or a new regime, if you on the market front.
Okay. No,
That
thanks
help?
for that. Yeah, definitely.
It doesn't look like there are any other questions. So before we look at portfolio performance, Melissa, go to slide 23. Just as a reminder to the committee, this is the quarter, you'll remember, when we update our capital market inputs and our expectations for markets. And you see kind of some of the factors in the backdrop we use to do that here. We won't, in the interest of time, go through all this, because I think we've kind of cataloged what our thoughts are kind of across these different areas. But nonetheless, we did want to test the portfolio's allocations and the return potential for the program on a go-forward basis with the benefit of these updates. So if you jump ahead another page or two, Melissa, here, I'll leave the backdrop and the outlook. So here are returns. Here are our 20-year outlook year over year. So you see the exhibit to the left. Where we were in the center there last year and where we are this year in terms of returns. And you see not a wholesale changes really in returns year over year. And in fact, in many ways, real returns, as you've probably read about, have been a bit dampened just given how well markets have done. So these are nominal returns, and that's important for the committee, because last year when we did this exercise, our expectation for inflation was about 1.7%. This year, it's about 2.5%, right? So that's a pretty meaningful pickup, as you know. Yet you see the return gains year over year, right, are really nowhere near, by and large, that pickup in inflation. And that's really right, real returns being somewhat de minimis. Anyways, the takeaway here is not big changes year over year in our expectations for markets, but nonetheless, we take those numbers and we put them into our optimizer. And if you skip ahead, Melissa, to should be the next page, the very next page should have, that's just the backdrop on our process for those that are interested. Here's the summary output from our analysis. So just as a reminder to the committee reading this, if you look at the current mix, the light blue shaded rows there across the page, upper left-hand corner, those are your current target allocations for the pension plans. Right, so we put those in, as you can see, across the entirety of markets and how the portfolios are currently allocated. And we get a modeled return with those inputs that we just introduced you to. So you see to the right there in the light gray shade, an annualized return forecast of 6.9% for your current complexion of assets. And then we just run straw men around that. We get the portfolio more and less risky, and we just frame around that as some other mixes just for your consideration. And you see there a much more modestly observation mix B is almost 43% fixed income, and then in the other direction, rounded, it'd call it 22.5, 23% fixed income, and we can frame around your existing observation or allocation just what the outcomes may be. So that just gives us some guideposts around risk return metrics and the like. The takeaway, I think, has always been the case for the committee, because you always kind of adopted our thoughts around diversification and disciplines around diversification. The portfolios, right, in a vacuum from an allocation perspective, model efficiently, right? You see that plot on, maybe of interest to some of you, the so-called efficient frontier, or that optimal statistical mix of risk and return, and the existing portfolio plots right square in the middle where you kind of think it would be, right? Because you are balanced, and have a mix of assets that diversify and combine well. The one thing to note, you do see there a 6.9% return does flash a little bit north of the existing actuarial expectation, right, which today is 6 5/8. So there is, we can talk about this there. And this is an exercise, as we remind everyone, right? We'd love to tell you we're going to get this precisely right, but frankly, we're not. So it's a little bit of an exercise in false precision, but there is a school of thought here, right? That the portfolios on the margin could be de-risked a little bit, right? We could go to a little more, less equity, a little more fixed income to align with that more precisely 6 5/8 return target that you see here. You've got more than ample in terms of the mix today to get you where I think we're going to get you over the course of the long haul. And the final reminder to the committee here, because I know it's been a point of interest and sometimes contention, this is just the asset classes, right? This does not contemplate any type of incremental returns that the certain of the active managers that you have in your program may generate over time. This is just asset classes. So I guess the takeaway, and we'll come back to it when we look at the portfolio detail, but the portfolios we think are in good working order on the surface from a statistical perspective, maybe with an opportunity when we look at the allocations themselves to take a little bit out of equity toward fixed income, because we do have there a couple of tenses when we talk about of incremental return baked into the current mix. So that is I grant you a lot of statistical gobbledygook, and we want to be sensitive to how detailed we get into this, and I want to be sensitive to time and the full agenda as well. But anything on the surface or kind of first blush from the committee in terms of the allocation exercise and what we're trying to accomplish with it?
I had a question.
Sure, Lisa.
So last time we met, we had asked you about the actuarial recommendation to go to 6.25, and you thought that that was accurate and appropriate. And now I'm hearing 6.9. Is that because that's a one-year return? We're trying to decide whether to go. Our plan was to go to 6.5 as of last year. Our actuary is now recommending 6.25. I know Glastonbury went there, Ridgefield. A lot of people are going there in Connecticut. Do you have anything? Can you speak to that?
Yeah, I think that's Lisa. I think that is. I think that is absolutely a trend that we've seen across the state, as you mentioned, moving through the mid sixes down into the lower sixes and landing. We have some who've landed at 6.25, as you mentioned. And again, if that is the committee's and the town's intent, right, then we could certainly do a little bit on the margin, and more so than kind of we're thinking here on the surface to the existing targets. So going to 6.25 would enable us to de-risk, but yes,
but obviously we have to make a decision and reduce some of the volatility. And so can you give us some thoughts as to the types of things we should consider? We don't want to de-risk too much if you think the actuaries are wrong.
No, I know we actually run in parallel to the Milliman numbers quite frequently, and no surprise that when they run their allocation exercises and compare them to ours, they're pretty similar, if not identical. So a 6.25, if the committee and the town has the wherewithal to do that, would be consistent and probably still ahead of the curve statewide. To the extent that you did that. And Lisa, the more pointed answer to your question, if you say, yes, we're going to forge ahead with that more conservative assumption, I think we could take anywhere between 5 and 7.5% out of equity and redeploy it to fixed income and change the mix equity versus fixed income. And as you can see on this table here, right, just framing around those fringe outcomes, put you right in that 6.3, 6.5% type of modeled return. Again, right, false precision. We don't know with absolute action what's going to happen, but on the margin, you could de-risk a little bit for sure.
And that risk would be advantageous to us because obviously the ARC payment is dependent on us hitting the target. So it would make that more likely. I asked that as a question.
Yeah, I mean, listen, I think that on the, we don't have to strive in terms of total return quite as aggressively, right? That means less equities in the program. Equities, as you know, statistically are more volatile than fixed income and other asset classes. So to the extent eliminating some of that exposure on the margin and going into fixed income, for example, the complexion of the portfolio, you see it there pretty explicitly, right? Look at the annualized volatility forecast for the existing mix versus that downdrafted mix, right, to the extreme there. And 12.2 point versus 10.4% of annualized volatility. So a pretty meaningful reduction in that volatility, both on a model basis and, interestingly enough, look in the very upper right-hand corner of the page, on an actual a historical basis as well. So we back test those mixes against the forecast, and you see there a pretty big downdraft as well in volatility, what's actually happened over time.
Is Amy on the line yet? Do we know?
Yeah, I'm here, Lisa.
Amy, just for the subcommittee's point, going from a 6.5 to a 6.25, I think you had mentioned the difference is about $200,000 on a $105 million budget. Is that accurate?
I don't remember offhand. I'd have to look.
Okay.
This is Amber. If I could ask just kind of a clarifying question about changing this rate down to 6.25, and I'm just going to paraphrase this. So if I am incorrect in what I'm saying, please let me know. But it sounds like the expectation is that based on our current portfolio mix, the return would be a little higher. And if we move our rate down to 6.25, then essentially that would allow us to change our mix and move some things from equity to less risky investments. So it's not that we would be going to 6.25 because we think that's what the return is going to be based on our current mix. It's actually an investment. It's a decision that we are making to change this portfolio to less risky investments. Correct?
I think that's what we're seeing today on the table, Amber, but that is not what we've discussed for the last 3 years as a strategy. We've discussed that the benchmark has been coming down, and we were shown a study from the actuaries last year on what the plan performance was. Honestly, the mix and the elimination, not the elimination, but the downplaying of risk is new as of this morning, honestly, if we were to go in that direction.
And I guess that's what I'm trying to figure out is like, we're not moving this number. We're not moving down to 6.25 because that is the expectation of where it's going to come in. If we move it down, that actually is kind of like a portfolio mix decision to make to go less risky.
So that's different than, Sean's right, that's different than what our actuary said to us. So we would like to get, I think, Amy, if we could get clarification from our actuary on that, because that is different than what I think our board took away from the actuary report to us and what's written in there. So could we get some clarification for that for our February meeting?
Yeah, I mean, and to further the point, Lisa, right, the 8.9 is the annualized return over the last, 35 years of this investment mix on the upper right there?
Yeah, that's right, Sean. Now remember, that's not your portfolios necessarily. That's the asset class combination, right?
Understood. But the actuary showed us a doomsday 5 3/4, which I think, or whatever it was, or low 6s, which I think is very confusing compared to what I'm seeing here. So Lisa's question is right. I'd like to see that trued up.
Yeah, and clarified, because what I think Sean's exactly right. By lowering the assumption rate, you ask current taxpayers to pay more. If we don't lower it and we're wrong, we're asking future payers to tax more. So we try and get it right, but we're hearing two different, I guess, analyses that don't appear to be aligned from our understanding of what the actuary said. So I think we're going to need clarification, because we don't want to make a move to go low if in fact our actuary doesn't think we need to. The report seems to indicate they do, but what we're hearing from you is that the asset allocation is consistent with the actuary and we can expect to make those returns, where our actuary is telling us, no, go down to 6.25. So I think Sean's exactly right. We need some clarification before the Board of Finance makes a move on that.
Yeah, and Lisa, just to further that, again, to Amber's, I think, original question, our intent before was to align our portfolio earnings with the advice versus the strategy we're discussing this morning, which is to further de-risk their profile, which we certainly can do, but that would be a pivot from what we've been marching towards.
Yes, and I think, Sean, you're exactly right. The reason why the Board of Finance was considering a move to 625 was not because we thought it was a good idea on our own, but because our actuary was recommending it. And we do follow, obviously, the professional experts' advice, but they're aligned with Fiduciary, who is also one of our experts. So there is certainly confusion here as of this morning.
Yeah, those are all great points and good perspective, right? I think in the end of the day, right, we're probably not as far off maybe as our intuition suggests, right? Even on the margin, if you were to take 5%, call it 7.5% out of equity to fixed income, and again, in a diversified manner, re-express that, and bring you down into that, mid to low 6 number. Amber's question was a great summary, right? This is a little bit of a chicken and an egg proposition, right? Because you're kind of circularly, what are our peers doing? What is the return potential in markets? What are we trying to achieve actuarially? And you go a little bit in circles on it. But I guess what I'd leave the committee with is just a couple of reaffirmations, right? And then we can move on. Return expectations have modified a little bit for sure, year over year. Again, remember those real numbers we talked about, and for a host of reasons, momentum across the state is moving from the upper and mid 6s down into the 6.5 and in some cases 6.25 ranges. And again, across our book, for those clients in that 6.25, 6.5 range, that the allocations, whether they're 35% fixed income or 37.5% fixed income or 32.5% fixed income, for mature plans like yourselves, and demographics that are similar if not identical. The construct you have today is maybe hopefully some comfort for the committee is very typical for what we see statewide. And you do have the litmus tests and the proof statements over time, right, in terms of actual generated return of pretty consistently meeting your bogey. So I certainly defer to and appreciate all the good input from the committee and happy to connect with the Milliman folks at your direction and kind of work through a full reconciliation. So with that, I'm sorry.
Yeah. No, I was just, is that what we're asking here for a reconciliation, Lisa and
well, I think, Amy can probably speak to this, but we have a recommendation from our actuary to go to 625. We're hearing from our investment advisor that perhaps that isn't necessary. So at least, if not a reconciliation, a clarification, because the Board of Finance is the really boring board. We really follow the recommendations of experts. But here,
I agree with that. I just think we're in very different times over the last 2 years where we've been, with interest rates dropping. Now we're in a situation where we've got inflationary pressures and, rates are moving. So people find a little bit of relief in seeing those interest rates go up. And maybe to Chris's point, maybe we can, in, a rising interest rate environment, move some of equity to fixed income. I'm not opposed to that. I'd like to continue the conversation on that. I think, I would not be in favor of increasing our allocation to real assets. But I mean, all up for discussion. Maybe we could get some clarification for our next meeting and further the discussion. And just for, I think, in terms of our overall looking to the 625, I mean, I look at it as, how, well-funded we want our pension plans. And to the extent we don't need to nail it on the head. We don't need to match, right, returns. Certainly if we outperform, then, our pension plans are better funded. And so it's a moving target. I would agree. I think we should, go on the recommendations of Milliman and Chris's team here. So I think we need a little bit more information, and then maybe we can decide on whether we want to move any allocations. Is that fair?
Yes. Derek, just for the committee members, Fiduciary, Chris, we have you coming to our November meeting. So if members of the retirement committee want to come to that, and we would certainly give you the opportunity to ask questions once we have clarification from our actuary for that part of the meeting. If you all have an interest in that, I'm certainly open to that.
Okay.
Great. Well, let me
Thank you.
quickly, if I would, Mr. Chairman, and then I've got a segue over to Tyler, of course, just so the committee sees, if you would, in 30 seconds time, we'll go through Melissa, page 31. We haven't talked at all. So the allocations for the plans, you see there, again, reasonably close to, right, to target weights, a little bit of fluctuation from market movements, of course, but by and large, and I think in pretty good working order from a larger allocation perspective. And as a reminder, right, when we're sourcing liquidity, we tend to do it from the overweight segments of the portfolio to just maintain that discipline back to target. So I think the roster of managers is largely in good working order. We had Met West elevated to discuss on a portfolio management retirement at the end of last year, but that has since reverted back to maintain and seems to be in good working order. So I think the portfolios as construed today are fine. If we jump to the next page, quickly, you'll see down in the middle of the page, the fourth quarter, we had the plans up about 4.1% versus a benchmark, investable benchmark of about 3.5%. You see fiscal year to date up about 4% versus 3.2%, and then kind of running off, more recently, incrementally above benchmark or net of fees, at least in line with benchmark. And the 10-year number maybe is an interesting bogey just for some of the new members, right? So kind of through thick and thin, and this committee always being very thoughtful and patient with managers and disciplined with application. You see about an 8.7% annualized return for the pension plans through the end of last year. So, I think there is a testament here to the long-term testament to the good work that this committee has done. So I think we're in good working order on that front. If we could, then I'll pause for any last questions on my side. But if we skip ahead to, let me see if I put it, I think it's all the way to slide 51, Melissa, just because there's some statistical detail there. But just so the committee sees the Oped portfolio details, one more page, I guess two more there. So there's the $23.5 million invested at the end of the calendar year, right? This has always been an entirely indexed portfolio with ETFs. And you see there aligned with target by and large. So good working order. Index, but very well diversified and full exposure to the opportunities in capital markets. So I think that continues to make sense. And then if you skip ahead to the last page, you'll just see returns for the program. So for the quarter, you see 4.6, 4.1, kind of similar numbers, right, to what you saw for pension because the allocations are reasonably similar. And then you see the totality of the track record. And again, right there, the opportunity for incremental return kind of washes out over time, right, because we're just all indexed for the time being. But good top line absolute returns for sure over the long duration of the program. So with that, Mr. Chairman, I will, absent any questions, invite Tyler in. I know you wanted to hear a little bit on the retirement plans, DC plans, before we stopped for the morning.
Yeah, thanks, Chris. That'd be great.
Well, we'll start on Melissa, page 66, I think, on your deck. Perfect. So as everyone knows, we have this governance calendar. So each quarter we focus on we always focus on the investments, but we have a different sort of fiduciary focus this quarter. Our practice and policy focused quarter. So I'll just give you a few updates from a regulatory and legislative standpoint. I also included a few slides that talk about ERISA best practices as fiduciaries. Again, this is a non-ERISA plan, but I think since the beginning of the committee being built, it was best practice to sort of follow the guidelines of ERISA that are outlined by the DOL. And I did include an investment policy statement. I don't have any recommendations to change the document. The only thing I'll note is it is, I believe it was a 2014 signed document by Mr. Cook previously. So it may be something, again, there's no changes that I would make. It's just an 8-year-old document. And so it may be worth over the next couple quarters reevaluating. We don't, again, have any recommendations to change the document, but at least updating the dates on it. So we'll talk about that in a moment. If you go to the next page, Melissa, and I'll go fairly quickly through the regulatory updates because a lot of this is still proposed, but and this actually wouldn't really apply to your current plan, but the DOL back under the previous administration in December of 2020 proposed some pretty strict rules on selecting ESG investment options or socially responsible investment options, and we're now seeing a reverse of that. So there's a new proposed rule as of October. It's under its comment period right now. That just gives you as fiduciaries a little bit more flexibility when discussing investment options around their sort of social impact, be it climate change or governance factors or workplace practices. And then essentially allowing for all things equal around the performance of investments, you as a fiduciary have the ability to select funds that may have a better impact on the quote unquote world. So just gives us a little bit more flexibility. You don't have any dedicated socially responsible funds in the plan, but if you did, or if say the employee base were asking for these types of investments, which we do see with other clients, we have some flexibility around that. The next page gets into a couple proposed legislation that one is with the House. So RISE Act of 2021 is currently with the House, and I'll talk about its impact on retirement plans. And then, of course, I'm sure everyone's familiar with Build Back Better and its potential impact of the retirement plan industry as well. High level, RISE really just looks to make retirement plans more available. For instance, make it available to part-time workers, allow you to incentivize participants to contribute to retirement plans, improve sort of some of the cumbersome disclosure requirements that are out there. That's again still sitting with the House, so we still don't know where that's going to go if it gets out of the House and into the Senate. Build Back Better, the theme, if the theme was make more plans available through RISE, Build Back Better is really targeted at bloated, large retirement plans and high net worth individuals taking full advantage of the retirement qualified benefits. And so it's targeting plan participants' abilities to convert large sums of money from pre-tax dollars to Roth dollars. So it would limit for particular individuals who make a certain amount of money their ability to do that. Right now, in theory, in any 457, 401A, 401k, 403b, you could allow for plan participants to take, say, $1 million of pre-tax dollars and convert it over to Roth dollars and never pay taxes on it again. And of course, Build Back Better is targeting folks that make a certain amount of money to not be able to do that. And it also will require distributions north of very large balances. So I think what's in the proposed rule is right now you have a minimum required distribution based on age. This would be based on income and balances. So if you had north of $10 million in a qualified plan, you'd have to take 50% of anything above and beyond that out of the plan every year, no matter what age you are. So again, all of this is theoretical. I don't want by any means this to pass tomorrow and you'll be blindsided by it. I'm sure they'll give us some time if it does get out of the Senate to make sure the plan is compliant and that administratively all of this can be handled. And the only other thing I just want to note, it's on the next page, and I've talked about this in the past, that there's been a lot of litigation within the higher education space. So a lot of the private universities and colleges have been have been sued over the last 5-6 years or so, the claims have been pretty much cut and paste. There are planned fiduciaries offered higher share classes than would have been available. So the share classes were more expensive than what could have been offered. And there was also claim that the fiduciaries of these institutions failed to negotiate lower record keeping fees, and participants were paying higher than reasonable costs for the record keeping portion. And then some claims, obviously, too many investment options, as well as having multiple record keepers, which, I say that that happens a lot in the university space. It also happens a lot in the municipality space. There's a lot of municipalities that have 1, 2, 3, 4, 5 different record keepers. So instead of just having, say, an ICMA or Mission Square or a Mass Mutual, whatever that record keeper is, you'd have 6 or 7 of these record keepers, all charging very high fees. And so there was a lawsuit that went all the way to the Supreme Court. The Seventh Circuit at one point ruled in favor of Northwestern, saying that because there was participant choice, and in the plan there were low-cost funds, even though not all of them were low-cost, there were some low-cost funds, that the Northwestern fiduciaries were excused of their responsibility. And as we'd expect, the Supreme Court shut that down and said, no, your fiduciaries are responsible for all investments within the plan, no matter if participants have choice or not. So it's been sent back to the Seventh Circuit for decision. But in essence, the Supreme Court ruled in favor of the plan participants, saying that they should get more protection by the fiduciaries in selecting those investments, and there's a larger responsibility on the fiduciary side to make sure low-cost funds, low-cost record-keeping services are in place for participants. I'll pause there to see if there's any questions about the regulatory litigation side.
Tyler, just if I could add, this is Sean. The excessive fee litigation is very popular right now in the plaintiff's bar, and it's so far, I think and correct me if I'm wrong, been confined to generally plans of 100 million and above, as that's where it's generally been most lucrative. But it is creeping its way down. It's also making its way into the insurance side with higher retentions, cutting capacity, and otherwise. So when we do renew our insurance, we need to make sure that we're keeping an eye out for that. But I think we're probably all right from this side right now, but something we need to keep an eye on.
You're absolutely right, Chad. Over the last, I think, 8-9 years, this plan has been benchmarking fees every year, and when lower share class funds are available, we get access to those. And then you've also just done an RFP, recently negotiate lower fees. So I think you're doing a great job. But you're right. The best insulation from litigation is not being north of 100 million. But when you look at some of the claims, you can kind of copy and paste and apply it from anywhere from a university at 2 billion to 20 million. The claims can be very similar there. So
absolutely.
I did include on 71 through 73 just a primer on what it means to be a fiduciary. I won't go through each one of these slides. Note that this slide there is all out of Erisa. So, again, this plan is not Erisa, but it is good to follow these guidelines when, evaluating and being good stewards of the retirement plan. You'll note that I put together these bullets here. We cover all of these things. You have obviously periodic meetings. You establish a quorum. You document meetings and minutes. We look and evaluate plan design. We spent some time talking about cybersecurity last quarter, and again, we make sure that the fees are reasonable based on our benchmark. So I think overall, and again, this is a little different than the pension, given it's participant directed, and so we want to make sure that you're hitting all these things, and I think you're doing a good job as fiduciaries.
Tyler, quick question. Are all these in our current policy, or should we update to incorporate these?
They're not, like fiduciary liability insurance is not in the policy statement. And I wouldn't recommend it to be included in it. It's just sort of best practice to have. We do address, the governance portions We addressed, there's no, some of the stuff is more administrative than investment, Lisa.
Yeah, no, for sure.
Yeah, like the procedure for locating lost participants, we reach out to Mission Square and make sure that they have a process in place and to locate someone who's left the town, moved away, moved again, right, and they have a balance. They have a process in place for locating that. So that's more on them than the committee. All I think the things that apply to this, to the investment side, are included in the investment policy statement.
Perfect. That's what I was looking for. Thank you.
So if we go to 75, you could see the balances in the plan. Again, up from about 14.5 to about close to about 16.5 million. 20% of the assets in that plus fund, which has been fairly consistent throughout the years, to be right around 20%. And then the next highest, be it the S&P index, the Fidelity 500 index. And then we're seeing, a good portion go into the target date funds, about 18.5% in the T. Rowe Price target retirement investment funds. We also show the 401A on the next page. Up again, given capital markets and performance, from about $500,000 to 3/4. And then the Board of Ed plan on the next page. What I'm also looking for is significant shifts or concerns around assets. There are a little bit more in the plus fund than especially in the Board of Ed. But again, that could be just a few folks invested there. So we can coordinate some discussions around Mission Square and their education advice program to make sure that people are getting the right resources so that they aren't trying to time the market or overly conservative when they're investing. Page 78, is the performance of the target date funds. So again, we offer the T. Rowe Price institutional retirement target date funds, lowest cost available funds for the share class funds through T. Rowe Price. You can see some slight noise on the quarter for performance. A lot of that is sort of T. Rowe's value tilt and sort of a growth shift we saw last quarter. But you can see longer term performance, within the 5 and 10 years top performing fund versus peers, pretty much across the board within each vintage. You can look on the next page, top decile performance on the 3, 5, and 10 years. So the funds are doing really well for the most part. Again, a little bit of noise on the quarter given their sort of value shift, but longer term they've really shined, and we don't have any recommendations to change that. If you look on page 81, with the core managers, the index funds are tracking as expected. The index, our active managers, with Western Asset as well as MFS, doing fairly well longer term. If you go to page 82, our patience with Eaton Vance Atlanta, sort of GARP manager, has paid off for the year, and is peeling off some of that underperformance longer term. So a little noise with the T. Rowe Price growth stock. Again, some of their tech stock selection, overweight communication sector hurt them over the last year. It's weighing a little bit on the longer term numbers, but you can still see top quartile performance over the last 10 years. So we don't recommend any current changes given longer term performance. And then, as I mentioned on 83, you can see the Eaton Vance fund which struggled a little bit for 2020. Really had a nice recovery for 2021. Is slowly peeling off some of that underperformance we saw in the 3 and 5 year numbers. So we do have all the funds on maintain. No recommendations to change the portfolio right now. I will bring you to page, I think it's 90 on your slide deck, Melissa. That's the start of the investment policy statement. I did review the document. Again, I think we do follow this very, very closely. We keep this document broad enough never to paint the committee into a corner. What I mean by that is there's no hard and fast rules around removing a fund because say a team's younger than 5 years, or it underperformed an index over a rolling 5-year period, we give a little bit more flexibility around the context of those investments. And so I do think that you do follow the document. The only comment I will make is it's signed by someone who doesn't work at the town anymore, and it is back up. The date on the document is 2014. So I'm happy to provide. Either way, I think because it's been enforced at some point, I'm fine having it. I just know that it's maybe a good refresher to do, given that it's 8 years. We can change the date and then potentially have a new person sign it. So,
Tyler, we can put that on our agenda and then refer back to the retirement subcommittee for a recommendation as well, and get that moving, if that's helpful.
Yeah, it's really up to the committee. That was my only comment, just saying, it's got Tom's name on it and was back in 2014, but the context of it's correct. So it's really up to, you can be absolutely fine with the date on it and all that, but I think the actual language in it, we wouldn't change.
Would you like us, just since it's an administrative update, just for us to do it at our next meeting and say there were no recommendations, or would the subcommittee like time to review it?
Personally, I would take the lead at Tyler. We don't want to paint ourselves into a corner. I think people should, review it anyway. But yeah, I think we should definitely change the date on it and get a fresh signature on it as well.
So what I'll do is I'll just update, some of the language on it, the dates on it, and then and I'll put it in a Word document form. So that it's not buried in the deck, and I will send that along to be distributed to the committee if that works.
That's great. And if the subcommittee invited to our next meeting, if you want to take a look and if you have any changes, we might be able to get it taken care of at the next meeting, if people are comfortable with that.
I think that's a great idea.
That's all I had.
All right. Thank you, Tyler. I think that wraps up the meeting for today. So I have a list here. It looks like, we will be making the recommendation to the Board of Finance for the experiential study to be paid out of the pension plans. I know that we will be having ongoing discussions about potentially reallocation. And then Tyler, we'll get an updated Word doc here. Anything else that the group would like to discuss at the next meeting? It doesn't have to be right now, but we would want to get that on the agenda and make sure we're looking at updated agendas. And does anybody have anything else before I entertain a motion?
A quick question. Yeah. Chris, you and Tyler last time put together an excellent executive summary 2-page. And I think it would be helpful to have that again for our February meeting, and actually at every quarterly meeting, so that the 3 boards can report to their full boards. It helps with the reporting. And then our actuary did mention, and this can be done in February, if you could just speak to the liquidity of the plan and the process that you use, so that our actuary showed that our fees that are coming in are not sufficient to cover the expenditures going out. So it doesn't, we do rely on liquidating some of the assets to pay benefits. And so if you could just talk about how you liquidate assets to meet benefit needs, or to Derek's point, how much cash we hold to do that.
Sure.
Okay. Do I hear a motion to adjourn? Amber?
I'm trying to unmute. Yes, I will make a motion to adjourn.
I'll second.
Thanks, Bert. All in favor?
Aye.
Aye.
Aye. Have a great week, everybody. Thank you.
Thank you.
Thank
Bye,
you.
folks.